Good afternoon, everybody. Welcome to our webinar today. We're waiting for some more people to log in. I see there's quite a few regulars on here and some new names. Welcome. Those of you that don't know me, my name is Sean van den Berg. I head up client education here at PSG Wealth. Okay, looks like most of the people in. Okay, let's get started. Today's topic is pros and cons about investing and trading. And as you can see there, my subtitle is, what is your wealth plan? So the gist of today's presentation, or the focus is, call it a investment strategy or retirement planning. But let's start it off this way. I think most of you are on this webinar because you're interested in your financial security. And we know that putting your money in the banks is one way of saving, but it's not a good way to obviously beat inflation. So the idea here today is to, you have to invest your money, yes, but having a plan to do that where the annual growth rate is higher than inflation. So that is the main focus of today's webinar. Saying that is, we need to find a way to grow your money so that you can obviously enjoy a happy financial future, if I put it that way. With the idea that obviously, because planning for your retirement is so important, one thing I want to stress, and you heard me say it quite a few times in today's webinar, is contact a financial advisor, and I'll give you a link to advisors later. But the idea is to help you develop a plan for your retirement, okay? To have a retirement plan, to have a wealth plan, put it that way. Okay, so let's get into it. Here's a quote from Michael Porter. Michael Porter says a strategy is about making choices, trade-offs. It's about deliberately choosing to be different. And when I say being different is have an advisor. A lot of us on this webinar know handle our own portfolios and things like that. But when it comes to your financial future, I believe it's also important to have, give you that guidance, give you that, have some guidelines in place, but from a professional person. Michael Porter, by the way, is an economist, he's a researcher, author, advisor, speaker, also obviously a teacher at Harvard Business School. So let's get into the gist. A lot of you guys on this presentation today, if we can do a show of hands quickly, how many of you manage a share portfolio? Okay, and you'll see there's a little place where you can put up your hands. Awesome. Okay, a lot of guys are putting up their hands. It's about 50% of you that manage your own portfolios. Okay, so what is the current position or current situation for most people? If I ask you a question, what is working for you? Where are you now? If you're managing your own portfolio, we see there's a lot of opportunities for substantial returns. You've got a wide range of choices or abundant choices. PSG Wealth, obviously one platform, many financial vehicles, from savings products right through to investing offshore. We're there to help you. But also, obviously, what's working for us, especially on the share market, if there's any trouble, I can sell my stocks quickly, I can get into cash. So, yes, liquidity is what's working for us. What are the challenges? And this is for a lot of people, the market volatility. And obviously, also, investing can be time-consuming. When I say investing, is pulling up the initial watch list, doing the research, and all that kind of stuff. But that's what the professional investor would do, and that's what separates him from other investors. Okay, so yes, it is time consuming, so it might be a challenge, but it's worthwhile. So, saying that, I'm talking about market volatility and those challenges. What does that lead to? I think for a lot of people, there's a lot of what I call investor confusion. We're unsure, we're lost, we're unclear, we're baffled. There are a lot of choices, and I always say less is more. But we're left in a situation, we don't know which way to turn, especially when it comes to investing and things like that. So there are certain stumbling blocks along the way to, let me talk about, there's a stumbling block along the line of the investment strategy or a retirement strategy. And one of those big stumbling blocks is not having a retirement saving strategy at all. Okay, I think a lot of people fall into that category, and that's again why I'm stressing having a financial advisor to help you with those decisions. So a lot of people postpone that thinking, off until a later time. Retirement is not important right now, or my wealth plan is not important right now, and enjoy my life. So very important. Now we put things off, and we hope that life deals us a lucky stroke or a lucky opportunity, but it doesn't happen that way. So number one. Number two, when it comes to things that can negatively affect our investment strategy, is not having a budget or not sticking to a budget. So the idea is that you ought to be putting a plan in place, but also be able to fund that plan, and obviously making money available. And I talk about money buckets. Put 10% of your money away into some form of investment, be it the stock market or wherever the case might be, but be disciplined in doing that. Ideally, obviously, you want to put more in that. The third scenario, well, I think a lot of people are confused or they battle with the scenario, is there is a lack of focus on long-term saving. So we're thinking more short-term. We're talking about our holidays and that kind of stuff, but we don't think further than that. So those are the three main problems, I mean, for a lot of people. So what's the ideal situation? The ideal situation is obviously where your money's working for you, but beating inflation, number one. And we've seen what's happened with the Rand. Obviously, recently the Rand has strengthened, but we've got a chance of the Rand weakening again, and obviously that's impact for inflation and interest rates and ultimately the stock market and ultimately your investments. So it's important to be in a situation where you can handle it. So it doesn't matter what age you are, we're talking about making our money work for us. So you can see you might start off small, and we have this magic of compounding. Your money starts growing faster and faster. And when we have our golden years, our money is growing and it's working for us. This can be a sapling of an oak tree, and ultimately call it the dividends from the oak tree will be the acorns, but also maybe getting the shade from the oak tree and things like that. But your dividends is leaving the legacy for your children. So yes, we're talking about building a retirement. We also talk about building a nest egg. So yes, we're going to talk about asset allocation, spreading your risk, but having a plan. That's our ideal situation. Having a plan gives you that peace of mind that we're working towards something, and that means a secure financial future. So how do we get there? What am I proposing today? So first thing I always say to people, when people phone me, they've opened up a trading account, and I ask them what do I want to do. They say, no, I want to make money. That's a common thing I always get. And I ask them, okay, what's your level of knowledge and experience? Most people are complete novices. It's amazing how many people want to get started, want to start trading straight away or investing straight away, and they don't know. Balanced. But the idea of talking about balanced, as a share investor, share portfolio, I want to build a balanced portfolio. I will have some financial shares, some industrial shares, maybe some resource stocks. So the rand gets stronger, my financial shares go up. The rand gets weaker, my rand hedge or my mining stocks go up. That's what I mean by a balanced portfolio. So I want to build a quality, undervalued portfolio with safe stocks. That's my focus. Can you also bring it? We'll talk about it just now. We talk about the different strategies. You might have some growth stocks in there too. But my focus as an investor is more. This is a share investor. Is more on fundamental analysis. Or they answer that question: what must I buy? How good will this company be as a generator of future profits or earnings? So I'm looking at what is intrinsic value. What's the real value of the company? So I use a lot of financial statements. And I also look at financial ratios to see if there's growth and what's the health of the company. My strategy as an investor is buy and hold. I can be a value investor, the Warren Buffett approach. I'm looking for bargains, so I'm buying shares below their value and I hold them for long term. Growth investor, I'm going for stocks that are doing much higher than its peers, growing much higher than its peers. It's growing its earnings, and the share price will follow that, much higher than the average. So those are what we call growth stocks. Then you also want to have some stocks in your portfolio that are high dividend payers. So my approach to the market is either what I call a fruit salad approach, bit of value stocks, some growth stocks, and some dividend stocks. But my goal, and this should be your goal also, your main goal as an investor is capital growth, way above inflation. They say inflation is 6%. I like to be a bit more conservative and say, okay, 15% plus, because the reason I believe is if I'm not making 15%, I'm wasting my time. I'd rather put my money in something else. So yes, capital growth, and then secondly, I'm looking for dividend income and growth in that dividend. If I'm buying and holding, I have low brokerage costs. And that's also very important when it comes to investing, because obviously cost over the long term has a big impact on your returns. And coming back to what I said right in the beginning, what is my time horizon? 3 years plus. If I buy a stock and I don't sell it, number one, I can't be taxed because there's no income. But if I do decide to sell after 3 years, then capital gains tax applies, which is much lower than income tax. Okay. And then if I have any dividends, we have it net tax. So dividend withholding tax is taken off. 15% is really taken off before you get it in your share portfolio. So that's what we call an investor. And I'm talking more specifically a share portfolio. What is a trader? On the other hand, anything less than 3 years, we talk about trading. Because obviously if I'm buying and selling, when my strategy here, we're buying and selling, receiver says that is income. Obviously, I'll be paying income tax on those profits. It can be as high as 41%. So the difference also is time horizon, but also the strategy is more active, so it's more time involved in managing a trading portfolio. With fundamentals, we talk about what to buy. On the technicals, we talk about when to buy and when to sell. So timing is a critical success factor here. I'll be buying and selling. I can be a position trader, so I'm taking advantage of more of the longer-term cycles, buy low, sell high. So position trading from a few weeks to months to years. Swing trading, anything from 2 days up to 30 days, what do we call a swing trader. And then some of you might be what we call day traders. You don't want to hold a position overnight. Day trading, you trade intraday. My goal as such is still capital growth. Instead of making 15% per annum, my goal is to make 15% per month. And this is where the derivatives, the leverage products are so popular. But my goal is to buy low and sell high. We always talk about breakout trading using various chart patterns and trend lines and things like that. But the breakout above the resistance will help me get into a trade. And obviously the idea is to sell a bit higher. I can also sell high and buy back lower. This is where derivatives come in, what we call short selling. So buy low, buy something at 5 Rand, I sell at 10 Rand, I made my money. Alternatively, with derivatives, I sell at 10 Rand, I buy back at 5 Rand. Okay. We also have what we call momentum trading. It's a style of trading where I buy high and I sell high here. Okay. So as a trader, I'm buying and selling. So obviously, I'll have much higher brokerage costs. So that's why I say the derivatives, like single stock futures and CFDs, have become more popular because obviously the costs are half. But just understand that income tax, you're paying tax on your profits as such. Can you see the difference between the two of them? There are some differences. You can compare them. Come back to the question I said just now. What is better, being an investor or being a trader? I suggest be both. Have an investment holding account and having a trading account. But the idea is to separate them. Separate your portfolio. Say to the receiver, this is my capital portfolio, this is my income portfolio. Don't tax my capital portfolio, tax me on my income portfolio. Okay. So I hope that helped you understand the differences between investing and trading. So we spoke just about level of knowledge and experience, and we just spoke now about the difference between trading and investing. It's your time horizon. So just to put into perspective a bit more, as a gambler, as anything I say less than 3 days, more of a day trader. You're going for you're trading on pure chance. You're trading news items, whatever the case might be, but in and out of the market short term. So index futures and currency futures is what the day traders use. This is more the advanced trader, but to a certain extent, you're betting on and hoping that the market goes in your favor. Then we move up to what we call swing trading, as I say, anything up to 30 days, and single stock futures are popular in that space. Remember, a speculator, a bit more higher risk. I'm willing to go for the higher risk because of the higher returns, but it's managing that risk. And we talk about position trading, and this is where CFDs come in handy. And a lot of you guys will be trading the equities. This is where we talk about 3 months plus. So position trading is ideal. Remember, CFDs, there's no expiry like with single stock futures. So yeah, you can hold it for a longer term period. And then we talk anything over 1 year as a buy and hold. We talk about being an investor. This is where unit trusts and equities come into that space. Okay. So the third thing I want to look at is your risk profile. And a lot of you know the story about the trade-off between reward and risk. High rewards, low rewards, low risk, and high risk. So some of you might be in this category here, where you are conservative, you want to preserve your capital, you're going for low risk, low rewards. Then ideally you should be in the money market or the fixed income market. But shares, directly involved in the share market, not for you. Okay. And this is, when I talk about investor, you can also look at it as a trader. This is where you want to be. You want to go for high rewards at low risk. So what we call this a prudent investor or a wise investor. So I always talk about high probability trading, when you bend the odds in your favor. So it's risk management, position sizing, stop loss, all that kind of stuff. And in the top quadrant here, we talk about being aggressive investor or trader. You're willing to go for the high rewards, and you know there's high risk involved. So you manage those risks very, very carefully. The last category you should not be in. This is what I call the speculatives, where you go for low rewards or high risk. To me, that's a zero sum. The probabilities are against you. Okay, so you're trading on pure chance there. Okay, so I hope that made it a bit more clarity for you guys if you look at the risk profile. So let's also understand, as we go along in life, there's different I call them life changes. But to clarify for you, when you're in your 20s, yes, you might be starting out, you're not earning a lot of money, but you have this time on your side, if you put it that way. So you can take advantage of the magic of compounding. What's important, this is what I teach my children at a young age now. It doesn't matter what kind of pocket money you're getting. Take 10% of your pocket money or 10% of your salary and save it. So start with a small contribution. The idea is to get into investment habit. So in your 20s, you want to be focused on growth assets, number one, and that's where PSG funds will come in handy. That's number one. And number two, obviously, when you're first starting out, costs are important, because over the long term, costs will have a big impact on your returns. Again, this is where the PSG funds were the lowest, 0.2% on fees. That's if you trade on our platform. So it's nothing else competes in that. So in your 20s, yes, we're starting out, but start small and let it start building. When you get to your 30s and 40s, the challenge here is that your expenditure starts to increase. Now you're buying a house, you might be paying off a car or getting another car, but you're starting a family. So yes, you might be more settled in your career and you're earning more than you in your 20s, but there's two sides of the story. Number one, you want to be managing your debt, very, very importantly, obviously paying off the debt as soon as possible. We talk about good debt and bad debt. Bad debt is the credit cards and loan accounts and things like that. Good debt is maybe your bond. Okay, so getting rid of the bad debt. But on the other side of the coin is having the discipline to have savings in place, having a retirement fund and putting those funds away on a dedicated basis. So if you haven't started saving yet at this age group, it's never too late to start saving. Okay. Then we get to when we get closer to approaching retirement, and generally most people do become more conservative, especially as their retirement nest egg grows. But also you must take in consideration that with medical advancement, people are living longer. So you want your money to work longer for you. So it's very important. We're talking about retiring at 65. You must at least have another 10, 20 years on top of that. So a greater portion of your retirement funds should be in equities longer than compared in the past. But also you should at this stage be saving as much as you can. Then we get to actual retirement age. And this is where a lot of people think of retirement as an event. We can't really visualize what it is right now. But for a lot of people, it's an extremely emotional time. Because remember, you've been getting up early every morning, getting dressed, going to work. You had a purpose. Now suddenly you're no more, you don't have to get up anymore so early. You might not, have things to keep you occupied. So it's emotional time. It also depends how you've prepared yourself. Retirement should be your golden years, a happy time. Some people look forward to it, some people don't look forward to it, and some people don't care. Saying that, as we get closer, as we go into retirement, obviously you're exposed to risk will adjust downwards, but do not forego the growth in your portfolio, because if you start underperforming inflation, obviously your savings will decrease. So those are 4 good categories. I just want to highlight the life changes that your strategy has to change as you move through these life changes. Okay, so let's talk about strategies. There's 2 parts. When you're still working and things like that, we talk about the rapid growth strategy. There your focus is on capital appreciation. I'll talk about creating wealth. And then the second part is when you want the safety strategy, where the focus is on wealth protection. We talk about wealth preservation. So those are the 2 areas that you as an investor need to be in control of. So the investment strategy must align with your individual financial goals. And obviously you as an investor must be closely following it and having the discipline to stick to that plan. And again, this is where the financial advisor will help you with that. Okay. So let's talk about different investment strategies. As a very conservative investor, your focus will be more on stability and the preservation of your capital. So this will be usually a cautious or a first-time investor. So yes, I'm focusing on growth, but I want to compete with inflation. So if inflation is 6%, so my returns must be at least 6%. But what's important is when we talk about the term. A very conservative investor will be investing in things like cash and bonds. Why? Because they have a medium-term investment horizon. A medium term is 5 years. I want to be able to get my money out within the 5-year period. So we classify this as a very conservative investor. So term is important. I talk about term and buckets. By the way, if you click on these links at the bottom here to take you to the funds A to Z, and from that, it's a tool to help you find the funds that meet your requirements. Very handy tool to play around with. Okay, then we move up the scale now. We get to what we call a conservative investor. A conservative investor pursues a modest level of portfolio appreciation with a minimal principal loss. So I'm worried about capital losses and volatility. So I'm still involved to a large extent in cash and bonds, but I do have some allocation into equities. That'll be equities over there. Okay, so I'm willing to and able to accept slightly higher risk or volatility compared to a very conservative investor. We move up the scale now, we get to what they call a moderate investor. This is where I'm looking for a balance between stability and appreciation. So the focus is still on growth, but I'm looking for greater diversification. And the idea is I'm still involved in bonds, but a lot more involved in equities now than exposure. So that's what we call a moderate investor. Moving up a scale further, talk about it being an aggressive investor. This is usually an experienced equity investor. I'm pursuing portfolio appreciation over time. So I'm willing to tolerate market downturns and volatility. And yeah, my view, I only need the money more than 10 years plus. So that's why I'm willing to take a bigger aggressive view on the market and more involved in equities, because market will recover, but my view is more longer term. And then we get what we call a very aggressive investor. So I'm pursuing above average appreciation. So I'm very much, to a large extent, heavily invested in equities. I'm going for my expectations. I have a high return expectation, but I don't need my money for at least 15 years. Okay, so those are the 5 different, call it investors or different investment strategies. The question today is, where do you fit in? Where are you right now? Okay. So we're talking about different asset classes. We're going to talk about the pros and cons now. So traditionally, we always talk about money market, the fixed income market, which is the bond market, and then the equity market. And a lot of professionals now are starting to bring in what they call the property market. This is physical bricks and mortar property. Remember, in the equity market, we've got listed equity, listed property rather. Okay, so we're going to go through the pros and cons. We'll talk about the money market. Those of you who've ever had a fixed deposit at the banks, you've been involved in the money market. So yes, very safe returns, very safe, but again, way below inflation. Okay, so it's somewhere where you park your money for the short term. Okay, the advantage here is it's extremely liquid. I can easily convert it from money market into cash. So in this space, there are a lot of unit trusts that will meet those requirements. Okay, and there's a lot of the PSG funds, for example, are very, very good. The disadvantages, as I say, low returns, below inflation. So, maybe as an investor, you might look at some portion of your portfolio be involved in the money market, but putting all your money into the money market, just understand those are the risks. Fixed income, so we're talking about the bond market. Now, historically, obviously, the investment returns have been fixed, or they are fixed. We talk about principal, we talk about yield. I'm not going to go into too much detail, but bond market is less risky compared to stocks. They're less volatile. And what's nice about these bonds have ratings from Standard & Poor's and Fitch and things like that compared to stocks. But you and I, as small private investors, it's not easy to get involved in the bond market. You need at least 100,000 plus. Yes, you can get involved in the SA retail bond market, but the easiest way to get involved here is, again, through unit trusts. The disadvantage is that those returns are fixed. If the market goes up or down, or the interest rates go up and down, you have a disadvantage. You do need much larger sums, as I say, more than 100,000 plus. They are less liquid than stocks. And the other big thing you must be aware of, obviously, in the fixed income market, we link to interest rates. So you have this interest rate risk. Okay, let's move on to the property market. This is physical property. A lot of us understand property. We might have our own home. So we're going to go buy a second property for rental income. So yes, it's most historically, apart from once in a while we have some housing crashes, but the returns have been very stable historically worldwide. The property market is less volatile than the stock market. But remember that the whole idea is, we want to create a rental income. So that's why a lot of people get involved in the property market. Another thing is, if I'm putting down 10% deposit and I'm buying 90% from the banks, I use what they call other people's money or leverage. And that's going to also be an advantage, because I'm putting down 100,000 Rand to have a million Rand exposure, 100 million Rand asset, but it's not my money, but I got the ownership. And also for a lot of people, it's much easier to understand a property. Yes, I've got rental income and things like that compared to the share market, a lot more homework involved. So those are some of the advantages. The disadvantages, obviously, not for everybody. A lot of people don't have the big lump sum to invest in property. And obviously, the other danger is that, yes, I might have other people's money involved, and I build up some equity in the portfolio, and now I go and take that money out and go spend it and buy a car and TV. Probably you have to pay that money back. So those are some of the dangers that you won't be able to afford it down the line. And you've got to pull the property out of the ground. So you haven't got flexibility, and try and sell the property. It takes a while, from a few weeks to a few months, so you don't have that liquidity either. Another disadvantage, I now have a property portfolio. It's hands-on management. Doing the screening of tenants and maintenance and repairs, that kind of stuff. I have a rental agent that does it for me, but it's headaches, but it's hands-on. Okay, and obviously the costs involved. So there's pros and cons with all these asset classes. And then lastly, obviously, the equity market. historically always offers the highest returns. You're also getting income from dividends. You can easily diversify your shares across a range of different sectors and industries, different countries. The more shares you got in your portfolio, obviously diversifying, between 8 and 12 stocks, between 3 and 5 different sectors, you're diversified. Another thing is about it is I can sell my stocks in a few seconds. My money's in my account a few days later. Okay, so you got that liquidity aspect. The disadvantage, as I mentioned right in the beginning, is the volatility. The market can pull back 10%, 20% very, very quickly in a very short period of time. And that also rattles a lot of investors. As a long-term investor, that's part of the game. Okay, so that's one of the things you have to be aware of. But what happens if you choose the wrong stock? You have the risk of losing all your shares. So it's not only what to buy and when to buy, obviously, is risk management. And then, as I mentioned just now, it takes knowledge and time to analyze the stock. So that could be a disadvantage for a lot of people that don't have the time. Okay. So here's a quote from Edward Lampert. Edward says the entrance strategy is actually more important than the exit strategy. So do your homework in the beginning. So you bend the odds in your favor. That's what I mean with this quote here. Okay. So what does this all do for you? What's the benefits? The whole idea is by having an investment strategy, it helps you with your plan of attack. Okay, it's your guideline in good times and bad. And that's what I want to stress in this webinar today. So it's your financial goals, okay, that incorporates that, incorporate your risk tolerance and obviously your life changes. Remember, we change our strategy as we go along, but also it feeds your future needs. When would you need some of this cash as we go along? So the components of an investment strategy will include things like asset allocation, your buy and sell guidelines, and obviously risk guidelines. Okay, so that's in a nutshell the benefits of having an investment strategy. So I know you guys will have some questions and things like that just now. We'll get into it just now. But some of you might be saying, but my financial plan, how do I tweak it? How do I bring more balance into it? Yeah, it's just 10 things that I thought of, some 10 ideas I put into the table. Yeah, start investing as early as possible. And as a lot of you guys are here, so there's a few of you on this webinar that are in your 20s. The earlier you start, the better. Take advantage of the magic of compounding. Compounding interest, Albert Einstein said it was the 8th wonder of the world. Invest in what you understand. Okay, so I know a lot of you guys get involved in trading single stock futures and CFDs. You've never traded shares before. Understand what's the underlying underlying instrument. And then we move on to things like turn discretionary spending into investing. And as I say, with my children, with their pocket money, I got them into a habit of taking 10% and putting it aside. And it's the same idea here. Your discretionary spending. Pay yourself first. Pay yourself into your investments. Okay, and I find the easiest way to do that is to have debit orders in place. So I set up and stick to a sound cash flow management system. That's what debit orders work. Before you know it, money goes into your account, goes out of your account, and it's done. So it helps you separate the emotions from your financial objectives. And also, as I say, it helps you put your investment cash reserves in separate buckets. Have different debit orders for different things. One thing I've learned recently, or the last few months, the importance of having tax-efficient investments in your overall investment mix. Take advantage of those tax-efficient investments. They're there to help you. And we have a whole range from tax-free investment plans to endowments to retirement annuities. These are financial instruments that are there to help you. And ultimately, all of this here, we're talking about having shares as your cornerstone to your strategy. Because why shares have always had the highest growth. Remember, growth, your biggest enemy in the share market is inflation. You want to be outperforming inflation. So, yes, I'm talking about shares, but also you want to be able to have a diversified portfolio across the different asset classes. But the idea is to also make small, infrequent adjustments to your investment strategy, not to your investment portfolio. Okay, so I hope that helped you guys. Let's go see what questions we're getting here. Okay. Question from Tony Moore. Yeah, okay. Just saying that PSG income funds are the best. Thanks, Tony. Awesome. Not too many questions. Okay. So, just in conclusion, what I want you to remember from this presentation, two things. have a long-term investment approach, long-term investment strategy, because remember the relationship between volatility and time. The longer your time horizon, volatility gets smoothed out over a period of time. So there's two parts to your retirement planning: building up the wealth and preserving that wealth. So we're talking about retirement funding and retirement income. So I hope this presentation has helped you guys. So what's the next steps? Just to get you guys started, there's links here to exchange traded products, voluntary investment plan, the unit trust, retirement annuities. And again, if you don't have a financial advisor, I sincerely recommend that you get a hold of one. Just come to consult you. Remember, it doesn't cost you anything. But the idea is that with the initial consultation. But click on that link and you'll find the closest advisor to you. And with that, obviously, help you towards your retirement. If you want more information, contact our client service department. There's the email address. There's our contact phone numbers. And from my side, good luck and happy trading. The presentation and the recording will be sent to you guys very shortly. So next week, we're talking about the webinar is choice and flexibility critical to investment outcomes. And the week after that, remember the webinar is on the Tuesday, not on the Wednesday, because the Wednesday is a public holiday. But the topic there is disciplined investment that comes with tax benefits. So I hope this webinar you found interesting. Here's my contact email address. There's our toll-free number. From my side, thank you very much for participating. Thanks for being on this webinar. Until next week, all the best. Bye for now.